Joining me now, Venu Krishna, Barclays head of U.S. equity strategy. Venu, thank you so much for being here. Appreciate it. So we're looking at tech kind of coming back a little bit this morning, even as we've gotten into earnings season, and the bank's reaction has not been as positive. But there seems to be a lot of optimism still going into this earnings season.
There is, and I think we are in that camp. We do expect in aggregate earnings to be up double digits this year. And what's important to note is that's happening at a time when we are not necessarily benefiting from any base effects. In other words, last year was also very strong. We saw momentum continuing from Q1 to Q2 to Q3, and we do expect Q4 to moderate a little bit, but you'll end up with double-digit earnings even in 25. So that's a very strong setup, for example, compared to Europe, where earnings have been flat for 3 to 5 years, and there's expected to be some pickup from there, right? So the setup is very good. We do think that tech and the broad TMT space remains central to getting where we want to. To the extent that a space wobbles, we have a hard time seeing the market managing to push through without their leadership.
And when we talk about leadership or not, lack of leadership, your team recently did some work on single stock volatility, the individual moves we see in stocks, which tend to be then magnified even more during earnings season as we're seeing the reaction to earnings. But when we're seeing so many individual sort of idiosyncratic moves, what does an investor kind of do with that?
It's very interesting because one of the interesting things, and we expect that to continue this year, is like you noted that dispersion within single stocks of returns has been extremely high. The corollary to that is the fact that the correlation, whether it is between sectors or for stocks within sectors or for stocks within S&P itself, is at historic lows. So in principle, this is an extremely good environment for stock picking and hence for active management. But the caveat is that returns still continue to be very concentrated. So if I look at the rolling 12-month returns, even now, or at least only 35% of stocks in S&P have done better than the index returns, right? So returns do get concentrated. If you look at the top 10 contributors to S&P returns last year, not surprisingly, 5 of the big tech 6 stocks are within those. So I think it's a very tricky market where in principle it is a stock picker's market, but navigating that is not going to be easy. And to your point, one of the points we noted was the volatility attributed to earnings has increased to the highest levels in a long, long time. So, and that's partly to do with the fact that information dissemination is moving very fast. So people are processing information, reacting, but that doesn't necessarily make an investor's life easier in navigating that. The last point I will make is that even big tech, on which we're very positive, which by the way is close to, call it 35% of the market and accounts for well over a quarter of S&P earnings, the correlation between those 6 stocks itself is hitting multi-year lows, right? So it was either ways to begin with in the 40 to 50% range in the past, call it a few years. Now we're in the 20 to 25% range. So if you can navigate even these 6 stocks, it can turn out to be great. But that's not to suggest that navigating and timing that is an easy task.
No, it doesn't seem like an easy task at all. I mean, and not only is it hard to perhaps look at the market from a macro perspective, sort of that quote unquote top-down perspective, but even applying sort of thematic lenses might be somewhat challenging. The growth versus value debate that has come back, or looking at certain sectors within the market because of that dispersion. Do you not want to buy the whole S&P 500 right now? You want to just go in and look at individual stocks?
Well, to the extent that you're confident in doing that, but it's going to be treacherous and tough. But owning the index is not a bad option at all. And I think, but if you look back, our own view is that we actually remain positive on fewer sectors, as opposed to buying everything, right? So we continue to like tech broadly, and within that big tech even more. We like financials and we like utilities. But the underlying theme which continues to dominate the market is a broad AI theme. And our core conviction is that it'll sustain this year, even though the level of scrutiny around that has decidedly increased. So we are now in the 4th year of this AI cycle. And as some of these big hyperscalers are increasingly tapping the public and private credit markets, there's an extra pair of eyes in terms of scrutinizing what the underlying fundamentals are, what the balance sheet strength is. And the credit market itself is being very efficient in terms of pricing the risks across. So in other words, if you look at where the credit default swaps or spreads are of an Amazon or a Google, it's very different than what it is for Meta, which is in the middle, as opposed to, let's say, an Oracle, which is another spectrum. So I think the market is sorting things out, but the theme is very much in place. AI adoption is expanding. The big hyperscalers are already monetizing AI to a substantial level in their own core businesses, and the use cases is expanding. That said, enterprise usage is still quite low. So I think the whole play now has entered a different phase of applications down the line for a wider adoption. But as we wait for that to unfold, I think tech, especially the big tech, and AI as a theme is the core of this market.
And it's interesting that you say that, because we were talking during the break about how we came back from our holiday breaks, rested, ready to go, and it has just been headline after headline, Truth Social post after Truth Social post coming from the president that have created some turmoil in the market. Is basically what you're saying, like AI is the more powerful force, and maybe try to disregard some of that headline risk?
Yeah, broadly speaking, I think the lesson from 25 is to ignore the policy-driven sort of chaos. And I think the message is broadly the same. The tricky part is every now and then, some of those policies are indeed translating into something very tangible. So what is the direction of that is important. And of course, this year is the midterm elections, so you can expect more, what should I say, policies more friendly towards sort of that process, but that has different implications. What does it mean for the deficits, which have been actually going in the right direction, but what does it then mean in the credit markets? Right now, the rates market, for example, is very benign. The 10-year is still sitting at 415. We are not in danger zone at all. Equities have done well. But to your point, though, the policy uncertainty is adding fuel to this dispersion we are talking about, where at the index level, things are relatively calm, including with the VIX, but at the single stock level, the volatility is very high. And if you look at each of these pronouncements, whether it is about credit card capping fees, whether it's about the ability of institutional investors to buy into the housing market, with the defense companies being able to buy back stocks or pay their in compensation, each of these has caused a lot of volatility in individual stocks for a brief period of time. And the question is, how realistic is it and how likely is it that it translates? So in the case of financial, for example, we remain very optimistic. I think valuations are decent, capital market activity is humming, M&A activity is likely to pick up, the yield curve has already steepened, I think it will remain steep, which is good for their fundamentals. So I think you have to have a thick skin and be able to look beyond the chaos while tactically navigating the market from time to time.
A lot of meditation on the part of desk traders this year, I think. Yeah. Thanks so much, Venu. Appreciate it.
You're welcome.
Tech, it's interesting because it's been lagging a little bit, right? And some of the valuations have come down to some extent. So I'm curious, as we get into earnings season, whether you think that the numbers are going to reconfirm some of the optimism, or that it doesn't matter because of how they're priced.
Some of the numbers will confirm the optimism, but it doesn't matter because they're expensive. So I look at this market as one that people think that fiscal and monetary stimulus stimulates the economy. No, it doesn't. It doesn't stimulate the economy. It stimulates asset bubbles. And as long as we are content to recklessly overspend, it will fuel surges in profits, and it will fuel surges in valuation multiples. So I don't see anything that would cause that to come to a grinding halt, but I would rather use the strength of the market to fade my existing exposure gradually and to redeploy money into markets that are cheap. Non-US stock markets, even after a winning year last year, are still very cheap relative to the US, and value is very cheap relative to growth. So to the extent people want to take some of the chips off the table on the growth side and redeploy them into markets that are cheap, I think that will pay off handily in the coming years.
It's really interesting that you say that about stimulus, because Kathy Wood of ARK Invest, well-known growth investor on the other side, she just came out with a letter to investors recently, and she said the economy is a coiled spring. That's what she called it. And she talked about some of the stimulus that should make its way, whether it's taxes or some of the other stimulus measures. What do you think of that view? I mean, that because we are going to see some benefits accrue, for example, from the tax bill.
Refunds are going to be huge. I actually suggested to the administration that they have an executive order and direct the IRS to issue 2 refund checks. One for what it would have been before the tax bill was passed, and the other for the difference from the tax bill.
That would be politically interesting.
It would be politically very interesting. But in point of fact, yeah, that's a one-off stimulus that's going to be huge. How does stimulus work? It puts money in people's pockets, particularly in the pockets of people with high propensity to consume. The middle class, the lower middle class, the working poor, they have high propensity to consume. They'll spend the money in the private sector, and that will bolster earnings. Bolstering earnings flows largely to management and shareholders. Management and shareholders have low propensity to consume. So they run out and put their money in VU, or our new Rouse ETF, and in so doing, push up valuation multiples. And so you have a surge in earnings and a surge in valuation multiples strictly on the back of stimulus.
And what's wrong with that?
There's nothing wrong with that.
Okay.
It does increase wealth inequality and income inequality. And so it achieves the opposite of its intended effect, but it does bolster wealth, and that's not a bad thing. It lays a foundation for when this $38 trillion in debt causes the markets to lose confidence in U.S. debt service ability. At some point, this has to reverse. But I don't see that as being in any way imminent. I think we're setting the stage for another financial crisis sometime in the next 10 to 15 years, but I don't see it as imminent.
So let's go back then to the here and now. You mentioned that international stocks still look like a good deal to you right now and have some more upside. Where else do you think that investors are not focused enough right now? What are some overlooked things that you think they should be looking at?
Well, one of the things that's just fascinating is we have this strange binary duality where investing is looked at as growth versus value.
Right.
Value is cheap, growth is expensive. Pardon me, expensive doesn't mean growth, expensive means expensive. It's actually a two-dimensional thing. Cheap versus expensive, and growing versus not growing.
Right.
Most stocks that are growing fast are expensive, but not all of them. Most stocks that are cheap aren't growing very well, but not all of them. And we need to throw that stupid binary worldview out the window.
Well, so let's take a stock like NVIDIA, which is much more reasonably valued than it was, so on a relative valuation basis, and it's certainly growing.
Oh, yeah.
So like, what do we call that? Is that a growth stock?
Oh my goodness, yes. We created RAFI Growth back last July. And I wish the idea had occurred to me 20 years ago. It didn't. But instead of calling expensive growth, let's call growth. If you identify companies that are growing rapidly, that is to say 5-year growth in sales, 5-year growth in profits, 5-year growth in R&D spending is high, those are growth stocks. Take the top 25% of the market, call that your growth portfolio. How do you want to weight it? By market cap, where you put most of your money in the most expensive stocks? No, how about doing it, weighting the stocks in the portfolio by the dollar magnitude of their growth? If you do that, the two biggest stocks in your growth portfolio will be Apple and Nvidia, because their dollar magnitude of growth is stupendous. In fact, each of those stocks individually explains 10% of all sales and earnings growth over the last 5 years. The nation's sales and earnings growth, 10% comes from Apple, 10% comes from Nvidia. So those are your two biggest holdings. There's two stocks in the Magnificent Seven that don't make the cut and aren't in our index.
No. Tesla? No.
No.
Tell me which ones.
It's Amazon and Microsoft.
Huh.
Their growth in the 2010s was stupendous. Their growth in the 2020s has been nice.
What's the cutoff between stupendous and nice?
Top 25%.
Okay.
So they're in the second 25%.
So it's on a relative basis.
Right.
Gotcha.
So their percentage growth rates are nice. They're faster than the economy, but they're not the blistering pace of the 2010s. Apple is impressive growth off of a huge base. Nvidia is stupendous growth off of a low base. The dollar magnitude of their growth is very similar. One because it was huge and grew quite a bit, and one because it was tiny and grew phenomenally. But if you do that, if you create an index where you choose stocks by the percentage growth rate, weight them by the dollar magnitude of the growth, going back over the last 28 years, we find that that would have beat Russell 1000 growth by 4.7% per year compounded for 28 years. So this is one of the exciting new product ideas that we've launched that it's not yet investable.
Right.
But it makes up one leg of what we call a trifecta: best value strategy, best growth strategy, and best core strategy available.
We're dissecting how to navigate the markets with Oppenheimer Chief Investment Strategist John Stolfus. John, it's always good to see you. Thanks for being here.
Thanks for having me on the show, Julie.
So, John, it has been an interesting few weeks of this new year, to say the least. But let's sort of zero in on earnings and what we've been hearing so far from the bank stocks. What is this telling you about how earnings are going to go and whether that's going to continue to sort of propel stocks higher?
Well, Julie, it's still too early really to judge the direction of the whole earnings season with really things just getting underway with the big banks. But we've got to say, with just about 5% of the companies, a little over 5% of the companies having reported thus far, I mean, my gosh, this looks like we're going to have a good earnings season, and a lot of surprises that are positive surprises. I think it's 82% are positive surprises. And we think the guidance is good. Some of the selling we've saw on good news, pretty typical of late. The traders seem to sell things. They sell less harshly on good news and positive surprises. And of course, they'll trounce something that disappoints. Even if guidance for the forward is better, they're show me. It's we're from Missouri kind of attitude.
Yes, definitely. John, as somebody who is pretty darn bullish for this year, I believe you have one of the highest, if not the highest, targets for the street. I'm curious how you're thinking about this year differently from last year, or if you are. Like, is the same playbook going to work this year?
It's a similar playbook, but it's a broadening playbook, and we've seen the broadening really goes back to the fourth quarter of 2020. It had been a bear market kind of year, and the market got trounced on a lot of negative pitch book stuff that was never realized. Earnings recessions and unemployment and recession, all that didn't happen. But the bounce showed an interest in things beyond tech, but with tech in the leadership. But it's become much more pronounced now. I mean, if you just look at what the market has done so far this year, I'm looking. Materials are the best performing sector year to date, up over 7%. Industrials nearly 7% up. Energy up 6.5%, and staples up 5.7 or 5.3. No, 5.7. It looks like I need reading glasses. But anyway, what we're seeing is a rotation, and it's not necessarily away from technology, as we would think. It's some profit taking to broaden one's exposure and diversification. And then the smalls and mids are doing great. They are essentially outperforming stateside with gains. Mid caps up 6.4%. The S&P 600, a better quality small cap, up 7.3%. And the Russell 2000, when the tide comes in and all ships float, up 7.76%.
I mean, it's been pretty remarkable to see that Russell 2000 make new highs and to see some of that other rotation that you're talking about. But John, man, we've been talking about broadening for a long time. This is something I've been talking to you about. I've been talking to other investors about for a while. And we've seen these sort of little feints at doing this broadening that then have faded. And so I guess the question is this a more sustainable broadening than what we've been seeing over the past year?
We believe it is. We believe that at this particular stage, we're beginning to see, if you just consider, what was it, the most recent GDP number, I think the third quarter came in at 4.3 versus 3.8 or something like that expected. It's the economy is showing resilience and strength, but not robust. We don't want to see robust. We like resilient, great operative word. And then in terms of corporate earnings, managements are doing well in terms of the consumer. Soft data, of course, can tend towards the negative, but the hard data shows the consumer keeps shopping, even though perhaps they've toned down the volume of spending. But at the same time, they still shop because in the U.S., we judge our jobs and our dedication to things on what we can buy indeed for ourselves and for our loved ones.
John, do you think that if the broadening is going to stick around, are you participating in some of the buying in some of these groups that you were just talking about, materials, industrials, even energy?
Right now, we hold positions in all 11 sectors. Our overweights tend to be infotech, communication services, consumer discretionary, industrials, and financials. But we also hold positions that are slightly overweight where the market is in energy stocks, as well as we have positions market weight related to utilities, as I recall.
And if I, as a bullish guy, as an optimistic guy, I think probably by nature as well as by profession, John, if I was to pin you down and say, listen, what could go wrong this year? What do you think has the highest likelihood of going wrong this year? What would you say?
Well, first thing I would say is anything can always go wrong. It's always the unexpected that bites, right? But we'd have to think here that on expectations, it could be just earnings disappointments, all of a sudden a realization that technology's morphing process has reached a plateau, like it did during the tech bubble. Or it could be short term, very short term would be some kind of geopolitical thing that would cause the market to wobble. But generally speaking, geopolitical risk turns into opportunity to buy shares because uncertainty tends to be profitable.
Concerns about the central bank's autonomy reigniting the Sell America trade for now. Joining me now, Keith Lerner, Truist Chief Investment Officer and Chief Market Strategist. Keith, it's good to see you. In your most recent note, there is one sentence that stood out to me, given the events of the past couple of weeks. You said, flexibility and tactical awareness are essential for 2026. That might be the understatement thus far of 2026 on the flexibility front for sure. And we do have more news hitting today, as we talked about in the form of these threats to Fed independence. So how do you stay flexible? How do you respond to a news item like that?
Yeah, well, first, Julie, always great to be with you. And you didn't mention it. In our outlook, we called it the seventh inning stretch. But we also said you'd also see some curveballs, and those curveballs you don't know sometimes that they're coming. And you can argue we've had two curveballs already with the situation in Venezuela and now with what's going on with the Fed investigation as well. So, and we're in a midterm election year. And historically, the one thing that we pointed out to our investors in a midterm election year, you tend to have a pickup in volatility because of some of potential changes along the way. So to your point, that's a long way of getting to your point about staying flexible. I wouldn't overreact to any one headline, right? But it does suggest that we have to pay attention to this. and this upcoming earnings season that's coming up, which is going to be crucial because to us, even though we've had all these different concerns over the last year, earnings have been key. So we're not making any substantial changes yet, but we're obviously monitoring the situation closely. And I think diversification is key.
Diversification key here, but are there implications for rates? And would there be signals that the market was sending that would indicate that there is a rising fear that Fed independence will be challenged and that there's less credibility when it comes to setting interest rate policy?
So some of the things that we're looking for around the concerns or questions about Fed independence is the bond market reaction and inflation expectation. So, and also the dollar. And what are we seeing today? Well, we're seeing a modest shift in each of those. The 10-year, it's up about 3 basis points, so not severe, but it is moving up. You are seeing the U.S. dollar weaken about 40 basis points as well, and you're seeing gold up. So what does that say to us? Well, one, we've been positive on gold all last year. We still see the benefits of having gold as a diversification in a portfolio. We still think that makes sense. And even though we still maintain this modest U.S. overweight, we've been increasing our international exposure over the last year. And one way the international markets benefit is if the dollar weakens and the local currency increases, and you're seeing that today. So that's the way we're thinking about the world more generally. And I would say, lastly, we've been Team USA for several years. We've been bringing that in because of several developments, and this just reinforces that global diversification is really key.
So in other words, Keith, it's not as though you're saying, jumping on the quote unquote sell America trade per se, maybe lighten up on America or rebalance a little bit towards international. In other words, maybe a little bit more nuanced than just the sort of sell America trade.
Yeah, and the way I think about it is, we're not making a change just because of the headline today. I would say relative to where we were 18 months ago, we have more international than we had before and a little bit less U.S. than we had before. But we still have that tilt. And also, when we have news headlines like this, I also don't want to get lost of other factors that will matter. I mean, like I said, the earnings season, the AI theme is still alive and well. I mean, just over the weekend, you saw this announcement by Walmart with Gemini, and Walmart stock's up 3%. That's not a recommendation on Walmart, but it's just saying, hey, this AI theme and this move to adoption is going to be really important. And ultimately, earnings drive the stock market over time. So I just don't want to, this matters, but it's not the only thing that matters. And corporate profits, I would say, over time matters more.
And Keith, I'm glad you talked about corporate profits because I want to get your take on the gap between that tech earnings growth and everything else, or put another way, sort of growth versus value, which is that debate's come back into the fore recently, right? We've seen value start to creep up a little bit. And I know the expectation is the growth still expected to outperform value, or tech's expected to outperform in terms of earnings, but the gap's closing a little bit. Is that enough of a justification to see continued gains in some of those value stocks?
Yeah, the way we're thinking about this is kind of similar to the U.S. international story. We still like tech and communication services long term. Those are legacy positions. But I think it's not either or. I think it's both. I think unlike in the past where it seemed like the tech trade was it, what we've done in our sector strategy over the last couple of months is we went to a overweight in industrials, which is more of that global kind of uptick in the economy. And then we also upgraded healthcare as well. And then more recently in December, we were underweight energy and materials. We upgraded those as well. So I think this broadening trade, which it seems like everyone talks at the beginning of each year and it hasn't worked out, we're actually seeing it actually start to work out. And the difference this year, or heading into this year, we're seeing those earnings borne out as well. So it's being supported. So I would just say it's a combination of both, but I would not get rid of your tech at this point. I just think there's more opportunities beyond tech is the way I would think about it.
The broadening maybe has finally arrived. Keith,
maybe.
Thanks a lot. Appreciate it. Good to see you.
Thank you. Great to see you as well.
Thanks.